Welcome to the 15th episode of our deep dive series on Canadian bank earnings. Today we're covering the second quarter 2024 bank earnings announcements, and we're going to return each quarter to this channel to update you on the latest financial results. My name is Daniel Stanley. I'm an ETF specialist at BMO Exchange Traded Funds, and I'm joined today by my friends and colleagues Chris Heakes, portfolio manager for all of BMO's equity and multi-asset ETFs, and Sohrab Movahedi, Managing Director, Financials Research at BMO Capital Markets. Today, we're going to cover the recent bank earnings announcements and what they mean for investors and the Canadian economy, as well as looking at different ETF strategies that give you exposure to the Canadian banks. So without further ado, Chris and Sohrab, thank you for taking the time to join me. And Sohrab, I want to start off with you. Last quarter, your thesis was that the Canadian banks were at an inflection point. So maybe share with us, how did the banks do this quarter, and are the results consistent with that thesis?
Yeah, morning. Good to be back. So let's see, Q2 results. The five big banks that we cover actually reported year over year higher earnings per share in the quarter. We were actually expecting a decline, although less of a decline than what we had seen in the first quarter. For us, or at least relative to us, it was a revenue-driven beat relative to our expectations, with both expenses and credit provisions, materially coming in line. Coming out of the results, we've kind of made no real material changes to any of our views or ratings, and quite candidly left our 2025 earnings estimates unchanged. So we didn't think this was a thesis altering quarter. In fact, I think things are going as we would have envisioned, or as we would have expected, maybe a little bit better, like I said, given the better revenue environment. And the better revenue environment, I'll say, oftentimes we talk about the revenue diversification of the Canadian banks. And I think it's worth highlighting that revenue-driven beat was the markets-related businesses. So those would be the wealth management businesses. Those would be the trading businesses, the capital markets type activities that have been going through had been going anyway through a bit of a prolonged lull. We're not really calling it a shift back to normalization yet, but it certainly does look like those businesses are firming, and I think at a time that we need them to, because volume growth, loan growth, that drives about 50% of the revenues, spread-based revenues, had been a little bit softer. So net, I'd say thesis remains intact. I think we are seeing improving year-over-year earnings trajectory at the banks. And just as a reminder that for 2025, we see the system kind of getting back to around that, I'll call it plus or minus 7% EPS growth, which is right around their medium-term published targets for growth.
That's great, Sohrab. Thank you very much. Chris, I want to turn over to you because Sohrab mentioned the five banks that we review, the sixth one being our own bank, and for obvious reasons, Sohrab's really not in a position to comment on that. But Chris, I want to talk to you about BMO, because after they reported their quarterly earnings, the stock dropped almost 10% from roughly $130 to $118. Talk to us, were there any other big bank stock moves this quarter? And do the moves in ZEB, the BMO Equal Weight Bank Index ETF, how do those moves compare to the stock moves?
Yeah, for sure. Thanks, Dan, and good to be here. Unfortunately for BMO shareholders, most of the other bank moves were of the positive variety. That BMO move is, unfortunately, that one-day move kind of puts it in the territory of COVID and 2008 kind of worst one-day price moves of the past 20 years. So, not the greatest to see, but resets happen in stocks, and that's not uncommon to see that. Some of the other banks did, fare much better, and I think following along some of the, the optimism and on the revenue side that Sohrab was referring to, we saw Commerce Bank up 7% on earnings day. Royal was up 5, National was up 2.5. So you had some good results. Now I would say Commerce largely sold off the next day, gave back a good chunk of that 7, but still, you did see some of that optimism come through. You know, the average price move across the 6 banks, including BMO, was a modest 0.5%. But again, that's pretty good when you had one bank dragging it down with a 9% negative. So that shows, I think, a few things, but, one is, the power diversification and using an ETF as a tool to just get exposure to the industry overall. And, certainly there's going to be some winners and losers on a quarter by quarter basis for sure. ZEB, as you mentioned, kind of delivers the overall exposure, so that can be, easy for some investors. But then the other kind of flip side to that is the opportunity embedded within some of the banks individually. And if you look at standard deviation of those price moves, maybe not surprisingly, the standard deviation was the highest in the past few quarters when you look at the price moves on the announcement day. One area we've seen that flow through to is our ZWB, so the BMO Covered Call Canadian Banks ETF, which supplements the long exposure in Canadian banks by selling call options to generate additional premium. As a reminder, we sell call options on each individual bank, largely. We do also sell call options on ZEB, but a lot of it's on the single banks. And that increase in volatility can be harnessed in a strategy like that to return more income. So more price swings this quarter for sure, positive and negative, and and again, you can use to ETFs in different ways to harness that.
That's great. Thanks, Chris. Sohrab, I want to come back to you, and I want to come back to the issue of provisions, and you sort of said provisions were sort of in line with expectations. When I was reading the reports that were coming out afterwards, it did seem like the theme was that most of the banks were still increasing provisions, if I'm not mistaken, and that it was affecting earnings. But again, from your perspective, is this a big risk going forward, or?
Yeah, so excuse me. So when we think about these provisions, I mean, the best way to think about it is probably both what you're charging to the income statement and then what sort of reserves you've built, if you will, on the balance sheet. And the way good lending works is you try and replenish your reserves when you have write-offs. And so in the context of the banks, we'll think of performing, let's call it credit reserves, and impaired credit reserves. Impairments, of course, being degradation in credit quality in the context of a commercial portfolio. It could be a borrower that gets downgraded heavily, or maybe even misses a payment. In the case of consumer or retail lending portfolios, it could be driven off of higher unemployment rate, or it could be higher interest rates, or what have you, that kind of impact the broader portfolio of a homogeneous portfolio of very small credits. The banks in Canada would have done significant reserve building on their performing loans. If you go back all the way to COVID, it was an off the charts type event. So there was lots of reaction to it. But the impairments actually ended up not spiking at the same rate that the reserve building had reacted. And perhaps that was a reflection of a lot of stimulus spending and the government programs that had been in place to retain kind of the economy. So you would have seen some reserve releases, for example, again, off the performing bucket as opposed to the impaired bucket. I think for the past 7 or 8 quarters, what you've seen is banks adding, if you will, to their performing bucket anywhere from 1 to 4 or 5 basis points above and beyond the impairment experience that they're having. And so this quarter, as a group of 5, they would have done about 44 basis points. So this would have been the total provision that they would have taken or charged to the income statement. largely speaking, around 39 of that would have been against the impaired book, and about 5 of that would have been further reserve building. So I think what's important to take into account here is reserve building will plateau at some stage when we've seen impairments peak. Okay, so I think good reserve building and balance sheet management would probably say, let's not deplete our reserves until we've seen the worst of it. And I think that we're near the peak. I think CIBC might be a good example of a bank that, for example, a year and a bit ago, went into the credit tunnel specific with the office commercial real estate issue, had to take some reserves earlier than their peers. And I think this quarter we got a message of reserve building, but at a more moderate pace, if you will. And while we're not really calling the peak on impairments, you could almost argue that impairments look to be plateauing or are near the peaks probably for this cycle. So I think reserves look still adequate to us relative to ultimately a no recession scenario, right? I mean, I think you don't always you're not going to be well reserved for the full gamut, but from a probability weighted perspective, I think given the likelihood of rates coming down, perhaps no concerns from a recession and economics slowdown type perspective that would spike unemployment rates. For example, for the Canadian banks, we would say the reserves are adequate. And of course, another important measure of balance sheet strength and the like for the banks would be the capital ratios that they have, and all very healthy, 13% plus. Royal Bank, the largest bank in the country, they closed on the HSBC Canada acquisition in March. So April would have been the first time they would have reported the results inclusive of that HSBC acquisition. And I thought what was probably just as encouraging sign, perhaps foreshadowing, was that with a 12.8% CET1 ratio, they did announce a normal course issuer bid. So they would like to do some buybacks, about 2% of their book. And I would argue that if a bank sitting with about 12.8%, obviously they are one of the higher ROE banks, so they have some good visibility into their internal earnings generation and capital generation, but they must have a more optimistic view or perhaps less of a pessimistic view on the credit outlook if they're willing to actually start spending some of that capital even right now. So my read of the announcement of Royal Bank actually would suggest that they too anticipate seeing peaks in the impairments perhaps by the end of this fiscal year. And that in the balance of probability of outcomes, you may actually even see some reserve releases in 2025, all of which I think would say we're not calling it the end of the cycle, but we certainly feel like we're very near the end of the cycle.
Well, thanks, Sohrab. No, that's helpful. And it's a good segue into my next question because you talked about, central banks. And Chris, I wanted to ask you this question. Sohrab, feel free to chime in afterwards as well if you'd like to, because it is a more macro question, but it's a question about the Bank of Canada, which led the group of 7 central banks and reduced the overnight rate by 25 basis points. That was last week. Chris, how do you see that impacting sort of broadly the operating environment for the banks and hence sort of impact on ZEB, the equal weight bank ETF?
Yeah, for sure. Thanks, Dan. And Canada was the first to cut rates. They beat the ECB, the European Central Bank, by 1 day. But we did get the gold medal in terms of the first rate cut there. I think Sohrab laid it out, really well. And I think from a macro perspective, it's really going to come down to, where we're at in the cycle and that softness of the landing. We talk about soft landings, no landings, harder landings. And I think that's going to be a big one. But, in the short term, certainly the lower interest rate, the cut was well received generally. Mortgage seekers, mortgage renewers, anyone, personal, commercial borrowers, it's obviously, relief there and stimulative. The thing I think to consider is, it's a bit of a double-edged sword. The Bank of Canada acknowledged spare capacity as being part of the reason why they didn't have to be as restrictive and gave them that ability to cut rates. We've seen some mixed underlying data coming out of Canada. The GDP, was a small miss to the downside. Jobs has been mixed, and we keep hearing about the productivity crisis in Canada. So, you're taking a step back. This bank rally that kind of kicked off in November, largely well, obviously it's not been a straight one way up. There's been some choppiness, but it was really predicated on lower interest rates. Canada, we are getting that, and it looks like there's more to happen in 2024. The market's pricing in 2 more for the rest of the year, and I think the governor was, all but saying there's probably more happening. Don't expect them all at once, but there's likely more to happen. So the read through to Canadian banks, I think on the Canadian side is, there's still some potential choppiness. I think it's, that state of the economy impacts, to Sohrab's point, the performance of the loan books, and that's going to have that's going to probably be the big driver. And Canadian banks are always that bellwether of the Canadian economy. But from a long-term perspective, there's a lot of things to like, and that 5% dividend yield, does pay you to wait. And I think that 5% dividend yield also becomes a lot more attractive as interest rate falls. As we get, we get 2 more interest rate cuts and that overnight rate trends towards 4%, well, 5% on Canadian banks, is attractive. I think we're, just touching on the U.S. setup, it's a little bit different in the U.S. And we'll just touch on that. But, the U.S. market, we're expecting 6 cuts to start the year. It's less than 2 that are expected, and they're proving very difficult to come by. The economy running much stronger overall in the U.S., the consumer being more strong. So that higher for longer interest rate story is still in place. Now, however, regarding banks, I think that soft landing or no landing scenario seems to be more kind of consensus playing out amongst investors. And given what happened to banks last March in the U.S. with the banking crisis, they've had a lot of room to recover. We're even seeing some fast money go into the U.S. banks trying to benefit from a possible Trump election. I'm not gonna wade into that one today. I don't think we got the time or maybe the time to get into the election issues, but we are seeing some fast money want to get in front of that potentially. But again, in the U.S., it's kind of a different setup. You're maybe not getting the rate cuts, but you're getting a softer and softer landing, potentially a no landing, and that's better for the credit cycle, I think. So that's kind of how I size up the two markets. And so certainly choppiness, but from a long-term perspective, I think it's it's looking more constructive.
Hey, Dan, it's Sohrab. If I could just add some incremental perspective to the yield concept that I think Chris was talking about. Obviously, Canadian banks, the dividends are an important ingredient to the total return story. The one bit of observation I'll share, and we've published on this, when you look at the latest rate hike cycle, drove quite a bit of funds into term deposits, GICs, for example, in Canada, presumably because they would have been higher yield with less risk associated with them. I think the interesting observation I'd share over here is we looked back about 20 years. We went back to January 2001, and we looked at previous rate cutting cycles, or when rate cuts first started. And obviously, these are, it's hard to be definitive about them, but when you look at the number of months it takes from the first rate cut to when you see term deposit balances at the banks to start kind of coming down, or you have net outflows, if you will, it's about 5 months. Now, the interesting thing I'd say is, why do some, one argument I could make that some of that money is starting to flow out of GICs is because the rates that you're getting on those are looking less enticing, let's say, relative to, for example, yields that you could get elsewhere. So what we did is we look to see what happens when that term deposit money balances, you have the net outflows, how long before actually the Canadian Bank Index starts showing outperformance relative to the TSX. And from the first outflow, so 5 months since the first rate cut, 6 months hence, so we're now looking almost a year out, the bank index has on average outperformed by 1,100 basis points. Okay, so over the ensuing 6 months. So to me, and to the work that we've done over here, that lines up quite favorably and consistently with our more optimistic outlook towards not only the second half of 2024, but towards 2025 as well. So I just share that as a bit of a data mining exercise, nothing more. And obviously, lots and lots of factors go into it, but it's just a reminder about the attractive yield play that the banks are, and that how that yield play has been less of a factor as risk-free rates had kind of run up quite aggressively in the recent past.
But it does reinforce that message that Chris sort of said, which is, you've got that yield to hold, and now you've sort of, based on the data you did, you can kind of put a rough time frame on when you start to see outperformance. Really helpful, Sohrab. Thank you. And thanks, Chris, for that. Chris and Sohrab, I want to take a step back and take sort of a more macro question to close things off again today. Chris, I'll start with you, and then Sohrab, you can finish us off. But guys, the Canadian banks, of course, are a massive component of the Canadian economy. They're heavily influenced by it. Look, if you just take a step back and take a bird's eye view of Canada, and if you're looking at the banking sector, what are some of the reasons to be optimistic as a shareholder as we move into the third quarter, and maybe some reasons to be concerned?
Yeah. So maybe this is kind of reiteration, but I just started saying, we're seeing the interest rate cuts coming through, potentially 2 more this year. That's rate normalization. That's also going to kind of reset the credit cycle, and some of the comments in terms of potentially the banks being well positioned around that already, I think are important. But that's bird's eye view that helps Canada. There's other segments of the Canadian market that have also kind of really suffered, in my opinion, with the higher interest rates, and some of the traditional defensives like utilities, real estate, telecoms, have not been strong equity market performers. I think with the Canadian banks, they benefit from strong overall Canadian economy in all sectors of the economy. So potentially a bit of a lift in some of those sectors off the back of interest rate cuts, helps the banks overall, helps the overall Canadian economy. We talked about the bank yield at 5%. That's becoming more attractive. Again, and not to rehash, but the well-diversified business streams, and strong capitalization always helps. Last thing maybe I'll just mention is the market valuation. And, there's a lot being talked about, say, U.S. market valuation. Price to earnings on the S&P 500 are around, 22 on a forward basis. Canada's 15, and banks trade kind of well below that as well. So, in terms of Canada and that kind of more larger playbook, and Canadian banks specifically, I think there's more room to be constructive, I think, than negative at this point, and a lot of things that should work over the long term.
Chris, what I'll maybe I'll build on that, and I'll say that let's look back first before we look forward. And I think if we look through 2023, it was a particularly difficult year, right? From 22 to 23, Canadian banks were dealing with higher regulatory capital requirements. I think, we forget, but our regulator here increased the domestic stability buffer twice. That's 100 basis points add to the capital requirements. And some of the banks had to basically introduce these drip discounts to kind of issue some equity on a consistent basis. They were doing that at a time where the markets related businesses were going through a prolonged period of loss, so that your revenues, at least half of the revenue stream, was not really growing. They were doing that at a time where they were still digesting remnants, if you will, of we don't even talk about it, but it was the Great Resignation, and how all companies, including banks, probably overhired and had to actually pay up to retain some employees. So you had the impact of inflation plus a bit of a bloated expense base. And they were doing all of this at a time that they were significantly beefing up their reserves, credit reserves, in anticipation of a tougher economic outlook, just the impact of higher rates on their borrower credit quality. Now that is a trifecta, if not, a four-factor type headwind coming at you. That was something that the banks had dealt with materially through 2023. Now, some of the banks have not, have only turned off, for example, the drip discounts halfway through this year. We are actually rather optimistic that the reserve building that has happened will serve them well. So I want to be clear on one thing. We're not trying to say there is a shift in the economy. What we're trying to say is the nature of the Canadian housing market, that the typical 5-year term of mortgages has required many bank mortgage holders and therefore loan portfolios to establish a degree of the best way maybe to put it is a lot of borrowers have acclimatized to this rate environment, and we've seen the negative impact of that from a discretionary spending perspective and what have you. So like Chris was talking about, if rates are coming down, if that actually creates a little bit of incremental capacity for those borrowers, perhaps $100, $150 less a month in mortgage payments, those are net additive, if you will, to an economy that has been actually feeling the contraction for the better part of a couple of years. 8 quarters of reserve building is quite a bit of headwind that I think has been absorbed for the bank. So, as we sit here today, a month or so ago, going into the results, I would have said, the market cap of the Canadian Bank Index, I think on May 14th, I measured it, was $620 billion. Coming out of the results and maybe having had a week or 10 days for the dust to settle, we're still sitting around $620 billion. So there's been some puts and takes between the banks, but the pie hasn't actually grown. And, we need that number to start kind of growing. When non-domestics start coming to Canada, the Canadian banks get more than their fair share of that funds flow. And, we've talked about this, I think, in the past as well. Non-domestics, the net outflows from Canadian equities by non-domestic investors probably is at a 2-decade high. So these are all signs of really bad times. The question is, do we get worse? Or do we start getting better? And I think our inclination is to think that we're starting to we're coming through. The light that we see is indeed the end of the tunnel, and so we're a bit more optimistic. And so I would expect, if not next quarter, then in the next couple of quarters, the proportion that the banks represent of the Canadian Bank Index has increased from, from the overall market has increased from 18% to 19% to 20%. And hopefully we get to over 20% by some time a year or so from now. So that's the positive pitch that I think we would like to leave our listeners with today.
No, thanks, guys. Chris, Sohrab, that's a great way to end it. I think, Sohrab, despite that trifecta of challenges that you brought up, that Chris, you talked about the dividend yield 5%, and at the end of the day, there's the challenges of the outflows from foreign investors. But at the end of the day, to your point, Sohrab, we're closer to the end here, and it's a great way to end off today's podcast. So Chris and Sohrab, thank you very much. Just as a quick reminder to the audience, you can get exposure to the Canadian banks via ZEB, the BMO Equal Weight Bank Index ETF, as well as ZWB, the BMO the BMO Covered Call Canadian Bank Index ETF, or you can get exposure to our U.S. banks ETF, ZUB, ZBK, which are the BMO Equal Weight U.S. Banks Index ETF. If you have any questions, please visit the ETF Center at bmoetfs.com. That's all for today, folks. Thank you for tuning in, and please join us in mid-September for the next update on Canadian banks.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.